$24 a year ago. Revenue rose 8.2% to $17.6 billion. The results exclude Kraft, which was spun off last month. Raymond Mathis, an analyst at Standard & Poor's, covers Altria and joins us from his offices in New York. Raymond, first of all, thanks for joining us.
My pleasure. Thanks for having me.
Let me ask about your reaction to the earnings, because fairly in line with expectations, as you say, but you said there's a lot of positives in this release. What are they?
Well, there are several positives. First of all, they had market share gains in some of the developing countries. Acquisitions were a big contributor. And most of the negatives were things that will probably be worked off over the next few quarters. For example, in Japan, there was an inventory work-off due primarily to some pricing issues and excise tax increases in that country in the year-ago period. So we think this is going to be something that's temporary in nature.
Let me ask first about the Kraft spin-off. I mean, how does the Kraft spinoff affect the earnings engine over at Altria? I mean, is it all cigarettes now?
Well, it is primarily all cigarettes, although they still do own a relatively significant stake in SAB Miller, which is a large international brewer, and they do have another finance division called Philip Morris Capital, which contributed to earnings and is part of the driver for the full-year earnings estimate increase.
Now, you talked about growth in emerging markets. I'm assuming since the Western world is pretty much making cigarettes illegal, at least in large public metropolitans, how important are emerging markets to cigarette makers in that case?
Well, they're very important. In fact, what we've seen in the last few years is that there's been a lot of consolidation, and some of the larger international tobacco companies have paid premium prices for some of the smaller tobacco companies in developing markets, pretty much because they need to get access to growing markets, because the mature markets, there's nowhere to grow anymore.
And, I mean, you do see stories coming out of Europe a lot that the major cities there, including Scotland and in the UK in general, are banning cigarettes in pubs. And you see that, you know, you can't smoke in schools anymore in France, which is amazing. Do you see this as really a big burden that they have to deal with?
Well, it is, and those are some countries where we have mature markets and where Philip Morris has a relatively significant market share. So this is a burden, but it's not unexpected, and as long as they can continue to make intelligent, accretive acquisitions in markets that are developing, where per capita use of tobacco is increasing, I'm pretty sure Philip Morris International is going to continue growing.
And, I mean, that's the main point that people have been talking about before this earnings release. Philip Morris International expected to grow a lot more than the domestic unit. That is actually the case, or that was the case, as they showed us. How important is it to investors that the company breaks up these two units?
Well, if you take a long-term outlook, I don't think it's that important, because I think the discount that domestic tobacco companies trade at versus international peers is probably going to erode over time, because the litigation environment is improving so dramatically here in the U.S. However, if you want to unlock shareholder value today, yes, it would be very beneficial for shareholders if the company were to split off, because international tobacco companies trade at a very significant premium to domestic tobacco companies.
And the expectation would be for the company to kick out its domestic unit and just become Philip Morris International. Is that the case?
That would probably be the case, because it's much larger than Philip Morris Domestic at this point.
And is that, I mean, you have a price target of $85 on the stock. Is that scenario included in your scenario for the $85 price objective?
Yes, it is. It's a sum-of-the-parts analysis, which applies a peer multiple to the international division and a slightly above peer multiple, because it has a largest market share, to Philip Morris USA.
So I'm assuming your price objective is somewhere in the 12-month range. How do you see the stock faring long-term? I mean, if the split happens?
Long-term, if the split happens, which? The international or the domestic division?
Kicking out the domestic division and just staying Philip Morris International.
Philip Morris International? Well, I think this company has demonstrated a track record of excellent management. It has excellent brand recognition worldwide, and when it's made acquisitions in developing countries, it's applied its marketing expertise that it's developed over the decades here in the U.S. It's applied its manufacturing expertise, and it's been able to consistently grow.
You know, one thing I often wondered, I lived in Europe for the past 8 years, and I noticed not many people really chewing Skoal or Copenhagen or any smokeless tobacco over there. Do you think that's going to come? Obviously, it hasn't picked up in the last 20, 40, 50 years, but do you think it's going to come as smoking gets banned more in pubs and in public places?
I think it will, and if you've been to the Nordic region, you'll have discovered that they do have smokeless chewing tobacco there. It's not the moist tobacco we have here, it's a dry spitless tobacco, which is what these domestic tobacco companies, including Philip Morris, including Reynolds, are spending a lot of research and development dollars on right now.
All right, Raymond, thanks so much for joining us.
My pleasure.
Raymond Mathis from Standard & Poor's. Now, still to come, a wireless company debuts on Wall Street.